What's going on, guys? Just gonna wait for everybody to kind of get in here. It looks like we've got a few folks in here. Um, so I'm just getting used to kind of everything here. Trying to see where the chat is. Oh, here we go. Yeah, I mean, if you're in here, let me know who you are, where you're at, what your Instagram name is. I'd like to, follow some of you guys and get up with you afterwards and check in on things, see how things went, all that. So. Just let me know if you guys got that chat. Still trying to get used to everything. I know we got some people that are starting to pile in now. Feel free to open up the chat, and just let me know. Can you guys hear me? Does everything look good? I mean, we'll get into the presentation here in a minute. I just want to give some people some time to get in here. Dom, St. Pete, what's going on, my man? How'd that interview go? I know Dom had a couple of big interviews this week. Oh, there we go. Got an offer. There we go, man. Well, we'll talk about it more. I want to hear all the details when we get out of here. So I'll reach out to you afterwards, man. I want to hear all about it. The frugal pineapple we were talking last night. I want you guys all to put your name in here, where you're from, and why you're here, and anything that you feel like is necessary that you kind of want to share at this while we wait for people to kind of get in here. But it's awesome to see you guys. If you guys have an Instagram account or like a finance account or personal account, whatever, drop your name in there, and we'll all go through and follow and help support each other. I want you guys to if you guys are part of my community on Instagram, I'm very grateful to have you guys there, and I want you guys all, using each other and supporting each other and helping out. So Renee from Port St. Lucie, that's my girlfriend's mom. That's another thing I wanted to tell you guys. If for some reason you hear the dogs start barking in the middle of this extremely loudly, just give me a break, because at some point my girlfriend's going to be walking in the door, and although they've seen her probably, she's working from home now, so every single day for the last year, it feels like, for the last 10 hours, they will bark very loudly when she gets in the house. So let's see how many we got about 19, 20 people. So I say we can probably go ahead and get started here in a second. You should be seeing my screen that says Zoom. I don't know if I'm going to be able to see the chat too much, once we get started, but what I'm going to do is I'll kind of be popping in and out of the PowerPoint, and I'm going to show you guys some stuff online. But first of all, I just really want to say thank you to everybody that's here. Thank you guys for taking time out of your night. I know you got plenty of stuff to do, but I appreciate that you guys are taking the time to invest in yourself, and also come and listen to me. Especially with all this stuff that's going on right now with the pandemic. I hope that everyone's safe, everyone's family's safe. So it's glad to see where everyone's from. If you got, like I said, an Instagram or anything like that you want to share or promote, go ahead and do it. Like I said, we're all here to support each other. If you guys have any questions, what I'm going to try to ask is to wait till the end and chat, or you can put it in the chat probably throughout. I might just not see it till the end, but I'd like to kind of go through everything, and then that way, if you have a question, maybe it's something that I'm going to answer anyways. So I want to be as efficient as possible with you guys' time. I don't want to waste any of it. So what we're going to do is just save the questions for the end, and then, like I said, if some people want to hang around, and they have questions, I'll sit here until everybody kind of gets their questions answered, and then we'll kind of go from there. Let's see if there's anything else. So I'm not worried about the presentation at all, but the only thing that I am kind of worried about, if I have to be honest, is like technical issues, just because this is my first first webinar on Zoom. So you're gonna have to hang with me. For whatever reason, some weird stuff happens. We'll figure it out. Please don't everybody jump out. Hang with me. We'll try to get whatever figured out, but hopefully everything goes smoothly. I've done a couple of like practice ones this week just to kind of get used to it. So hang with me on that. If you have a notepad and a pen, or you're taking notes on your computer, whatever whatever's best for you, I definitely would recommend. There's going to be a lot of information. I'm going to try to explain everything as fluently as possible, but I'm also going to try to get through it. Like I said, I want to be efficient with your time. So try to keep notes. If you have a question, maybe write it down on the side, or throw it in the chat. We'll get to it when we get to it. But again, we're basically just going to be going over a financial plan tonight, kind of just basic stuff of money coming in, where's the different places that it goes, how do we keep track of all this stuff, and then we're going to go over into some extra definitions and things that are important to know: income, expenses, net worth, all these different things that maybe these buzzwords that you've heard, just kind of explaining what they are, how do we define them, and how do we use, how do we find out our own numbers in those situations. So that's what we'll do. And then I'll show you some tools online. And then at the end, I'll show you I've been messing around with my own financial plan. And it's like, I've just kind of been nerding out on it, on this, it's like this flowchart website that I found. So I'll show you guys that kind of later towards the end. So hang around, stay as long as you can. Like I said, if for whatever reason you got to cut out early. You can DM me anytime. Anybody that's here, like I said, I'm forever grateful for you guys, and I hope that you'll stick with me and grow with me through the account. So without further ado, I'm going to go ahead and get into this PowerPoint. You guys should see it here on your screen. Trying to drag some stuff around, get some stuff situated. So here we go. So the goal tonight, like I said, is to learn a solid foundation. And to start to kind of build a plan, and then take action from there, and try to get you guys situated, start making some moves in your financial game. So obviously the first thing, before we go into anything, unfortunately due to the age that we live in, we got to start with a disclaimer. So this webinar is for educational purposes only, and information is not financial advice. Please consult with a financial professional to be sure to take into account all of your life's factors to build a plan that fits your life. So that, long story short there, obviously, is I don't know who you are. I don't know exactly where you are, how old you are, if you have kids, how much money you have. So we're going to go over things that are more foundational principles, and then build on it from there. So we want to take this as a foundation, and then we want to build on it from there. So first thing I want to go over is, who am I? And I don't do this to impress anyone, but as Jim Quick says, I do this to express what is possible. I have been able to accomplish a lot of things in a very short amount of time, and that's not due to any real shortcut or hacks. It's due to really hard work, educating myself, and all that kind of stuff. And the second reason why I do this is because there's a lot of information out there from people that haven't necessarily accomplished much in their field, and that's fine. A lot of Instagram is people showing their journey, and I 100% support people showing their journey. But when it comes to advice, or it comes to education, comes to teachers, I want to show you guys, hey, this is my track record. This is what I've done, so that you guys see me as credible, which I am. And that way we can just make sure that you always want to make sure that you check your sources. Who are they? Where are they coming from? Reviews, all that stuff. So a little bit about me, as you see there, I got my degree in finance from the University of Central Florida. I do work a 9 to 5, which we'll go into a little bit later. I am a millionaire at 27 years old, officially as of this year. A lot doing parts of finance, personal finance, stocks, real estate. As you'll see, I have 10 plus sources of income. We'll go into that later when I show you my financial plan. About $500,000 invested in the stock market. Hoping that will be at $500,000 or more by the end of the year from continued contributions and investment returns. And then, I'm starting to get involved in real estate as well over the last couple of years, and I'm looking to continue that. So the last thing is the Instagram. Obviously, I started it to help exactly for situations like this. I want to provide education and help people kind of learn from my journey and my maybe successes and my failures, so that you don't have to maybe take, even though some people might see 5 years, 4 or 5 years as a very quick time. There's obviously, if I could go back and do it again, I might have done it a few things differently. So if I can help somebody skip a step or, learn something without having to do that the hard way, that's what I'm here for. So what is personal finance? So a lot of people think, okay, finance, they probably think stocks and Wolf of Wall Street and, all those things. And that's not necessarily wrong. But personal finance is more so all of it together, how it connects, how your money comes in, how you save it, how you use it on expenses, how you budget, your bank accounts, your insurance, your mortgages, your car payments, investments, which that's kind of, investments are the area that people more so, define finance as, but that's really just one small part of it. As you can see, retirement planning, tax planning, estate planning, which is just basically making sure you're prepared to pass away. There's no really good way to say that. But obviously there's a lot of implications based on the kind of money and wealth you have when it comes to that time. So you want to make sure that you and the people that, you leave behind are, more than taken care of. So why is it important? Why are we here tonight? These are a few stats. And if you ever have time to just Google personal finance statistics, it will blow your mind. And probably not in a good way. But the good thing about these things being so bad is that it means that we can make some small changes. We can do things like tonight, and we'll be ahead of the majority of people, right? And we'll be on our way to better and better times. So as you can see here, over 40% of Americans have less than $10,000 saved for when they retire. I mean, obviously that's just an astounding number. And regardless of where you find yourself on that spectrum, it doesn't really matter, because like I said, we're here to move pave a new path forward. So 50% of millennials don't have any money saved in a retirement account. So that's, or 56. Why that's so important is when I think of millennials, for some reason I still think of myself, right? I'm 27 years old. I think of like maybe 20 to like 28-year-olds, but millennials are actually, I think it's like 22 or 23 to like 40. So like, that changes the statistic a lot for me when I see 56% of millennials who are maybe in their 30s, 30, 35, 40, don't have, not a lot of money. They don't have any money, right? So like I said, these are statistics not meant to scare anybody, but more so to say, hey, this is the situation that's going on. And the first step I always preach is to become aware, right? We've got to become aware. We can't fix a problem unless we are honest with ourselves, not for the purpose of beating ourselves up, but for the purpose of building ourselves up, right? So it's just the opposite. About 77 million Americans, or about 23%, have debt in collections reported to their credit files. So that's not just have like money on a credit card. That's like they haven't paid it. It's gone to collections. You're in trouble. It's on your credit report. So, but like I said, that's just a tidbit of why this is so important. So these are the things that we kind of need to figure out, right? So personal finance is not one size fits all. You can talk to a million different people. If you go talk to 10 different successful people, they'll tell you they're doing every single thing, maybe just a little bit differently, but most of them have principles, right? Foundations that are the same, right? When you look at houses in a neighborhood, this might have, it might be purple and this might be green. This might have a shingle roof and, this might have whatever, but they all have the same foundation for the most part, right? It's that concrete, solid base, good to build from. So that's what we want to go over tonight. But some of those questions, you might want to write these down. There's a lot of them. If you're looking for more, you can definitely Google them. But this is awareness, right? This is the first step. This is self-awareness. So these are questions we want to ask ourselves in order to develop our own plan, because I can tell you what I've done, but that might not work for you, right? For a million different reasons, which we can go over later. But So here's some questions. How much money do I need on a yearly basis to live comfortably, right? That will lead you in the direction of how much money do I need in retirement, right? And then we can start building it back. We want to start with the end, and we want to reverse engineer almost every number that we can think of, right? So, what reverse engineering basically means is starting at the end. And I do this with my goals. I do this with my financial goals. I say, hey, when I'm on my deathbed, right, and I'm sitting there and I'm there with my family, what do I want to say that I have accomplished, right? And then I work back, right? And then I go, okay, so how do I make sure that I end up in that spot, because that is the ultimate spot to be in, right? To live a satisfied life. So same thing with this. How much money do I need on a yearly basis to be comfortable? And then we start working our way back and go, okay, how do we do things on a daily basis? How do we invest? How do we save to get us the goal? Because I can show you how to invest and save, but you know, if you don't really have a number in mind and you save $10,000 and then you're like, well, actually, you know, I need a lot more than this, right? So you've got to figure out that number for yourself. When do I want to retire? How old am I? Hopefully, you know the answer to that one. Where am I at currently, right? And what that means is financially, right? So, you know, we'll go through different things, and you'll be able to better figure out what I mean by where am I at currently, because you'll be looking at your income, your expenses, your debt payments, your savings accounts, your investment accounts. And then the last one is really the biggest thing, right? And this is why I don't preach like the disclaimer attitude, because I don't feel confident what I'm saying. I say it because I'm confident that everyone is different. Everybody on earth has different answers to this last question. What are my goals in life? What do those goals require financially, right? Do I want to go to school? Are there vacations that I want to take? Do I want to start a business? Do I have children? Do I plan to have children? Am I married? Do I plan on getting married, right? Because there's a ring, there's a wedding, there's, you know, maybe a house, there's all these different things, right? Do I want to move to a different town? So these are all questions you've got to kind of figure out, and you're never going to have the answers, of course, 100% to all of those. But, you know, that's why it's important to, you know, look into these things so that you can make some better financial decisions. So this is where we're going to start our financial plan example, right? So you can kind of build this however you want. You can start with income at the top and then do the 4 down below. But our income is, which we're going to explain in a second, goes into 4 things, right? For the most part: expenses, debt, savings, and investments, right? And so everything else is typically going to fall into one of these 4 categories. So here's kind of an example. We've got Sarah, right? She's got it going on. She's got $2,000 a month in income. And I wouldn't be too concerned with, hey, I make $1,000 or I make $2,000 or I make $10,000 or $20,000. You know, as far as the percentages, I wouldn't be too worried about that just yet. Let's just kind of look at it as an example. So she's got $2,000 in income, right? So now she's got $1,000 in expenses. That could be, you know, a car, rent, this, that, whatever, food. Debt, obviously like student loans, you know, car loans, anything basically with a loan on the end, mortgage loan. And then savings, right? Which we'll go into all these, so you don't have to worry about the explanations just yet. And then investments, right? Investment accounts, stocks, you know, whatever it might be. So income, and I did a bunch of posts on this the other week, right? And the main gist was income is the most important thing, because without income, you can't do any of these things, right? You can't own a home. You can't own a car. You can't pay down your student loan. You can't save money. You can't invest, right? There has to be money coming in, right? Which is a pretty basic idea, but it's missed a lot because people are, you know, stuck in jobs where maybe, and you shouldn't take a job just because it's paying you more money, but if there's a job out there that's maybe paying you the same money in the same city, which is a lot of times the case, and maybe you don't like your job, then yeah, maybe it's a good idea for you to look into something that's going to be paying you more, that might give you better flexibility, or maybe you work less hours, freeing you up more time to do other things. But there's a lot of ways we can get income just besides thinking, hey, I have to have a 9-to-5 job, which I'm not saying the 9-to-5 is wrong. I have a 9-to-5, right? I'm saying the 9-to-5 is a big part of it, but depending on how much you make from that 9-to-5 job, you can put other things in your life to continue to build you income, right? This is another thing. There's not one way of doing this, right? So as you can see here, we have active income and we have passive income. So active income, think active, right? If you stop working, the money stops coming in, right? So that's like your 9 to 5 job, like rideshare is the example there, like Uber. Obviously, if you don't work, you don't get paid. So the thing is there's a number of different ways to get to 25,000, 50,000, 100,000, whatever it is that you determine that you need to make in order to save enough, invest enough, all that stuff, which we'll get into later. But you could have a 9 to 5 job where you're making 30. You could have a part-time job where you're making 5 a year, right? You could have a side hustle where you make jewelry, right? And you're making another 5 a year. And then now you're at 40, right? And also the big thing that income does is if you were making 30 and your budget was, hey, I have $30,000 minus taxes or whatever, and I'm going to spend the rest on my expenses and debt and all that stuff. So now when you start a side hustle, or like a jewelry, or it can just be a second job. It doesn't have to be you don't have to be an entrepreneur. You don't have to create anything unless you want to. But what you've done now, when you create $10,000 on the side, that's money that was not in your budget. So you can do whatever you want with it. That immediately should become your savings or your investments, right? Now, if for some reason that doesn't work for you because you feel like you don't have the time or you don't want to do it, or maybe you make enough from your 9 to 5, maybe spending an extra hour or two at your 9 to 5 job, I'm sorry, maybe if you're commission based or something like that, maybe that might make you more than $10,000 or $15,000 if that's your goal, right? So that's the important part. If that's something that you decide is important enough for you to do. So, but the game one step above that is passive income. So passive income is passive, right? So think laying back, passive, not doing anything, money coming in. You're like, well, how the heck do I make money if I'm not doing anything? Well, you take your money from the active income section and you move it into the passive income. So you invest your money, right? So the examples there are dividend stocks, which are just companies, just like regular stocks, but companies that decide, hey, typically it's larger, slower growing companies. So they want you to invest in their company, but instead of investing in Tesla or something that's going to, has potential, right? I'm not going to say it's always going to grow, but has potential to grow. This company maybe doesn't have as much potential to grow, but they'll say, hey, I know we're not, going to maybe grow as much, but we'll pay you 2% a year on top of whatever we grow or decline, right? Or 5% or 7%. So that way, every single year that 7% or whatever it is coming into your bank account. So if you have, $10,000 invested, you'd be making 7%, which is like $700 a year, right? So that's passive income, and you build it up, right? It's the $700 isn't going to get anybody, quitting their job, right? But you build it up over time. You build up your active income into your passive income. Rental real estate is another option. Obviously, that's buying properties, but you become a landlord to get a property manager, and then those rent checks coming in every single month. Those are for sure. It's coming in, it's consistent, it's income, and then the other things, business income and royalties, which is a lot more complicated. You got to start a business, and then basically get it to the point where employees are running it for you, and then you're consistently still getting paid the profits. So the next part, as you can see up here, we're doing like this little corner thing. We're gonna update it as we go. So expenses, anything you spend money on. It's really, people get harping on this so much, saying, hey man, I gotta cut costs. I gotta do away with Starbucks. I gotta, I can't be, spending money on these little things, $5 here, $5 there. Yes and no, right? It really depends on your situation. I think that if you're at the point where you have absolutely no money to invest, and you're maybe not making a ton of money, then the best thing to do that you have the most control over immediately is your expenses, right? You can lower your expenses. You can not go out to dinner, right, and eat at home. You can not, go get coffee or wherever it is. But even within expenses, a lot of people focus on those little things, but really the way to make the quick difference is focus on the big things first, right? So your rent, what are your biggest expenses? Rent, your car payment typically, insurance, your gas, shopping, dinner, restaurants, alcohol, whatever it might be, right? So Travis brought up a great point. Our expert house hacker here. The biggest thing first is your rent. So there is a thing that we'll get into in another webinar. I'm going to do one specifically on real estate where we go into house hacking specifically. But basically, you buy a duplex or something, and then you charge the other person that lives in the other one rent, or you buy a 3 or 4 bedroom home and you rent it out to 2 or 3 people. You live there, and then if the mortgage is $1,500, you would charge them $500, $500, $500. This is super basic, so it's not going to be exact, but $500, $500, $500, and then now that $1,500 goes and pays your mortgage. Guess what? Travis lives for free, which Travis actually does. So that's a way that you can immediately cut out. I mean, how much is your rent? I mean, do it right now and times it by 12. Is it 500? Is it 1,000? Is it 1,500? Right? $1,000 a month is $12,000 a year. Some people are spending like $2,000 living maybe in a downtown apartment, right? And if you make enough money, then do whatever you want to do. But if you're looking for ways to live cheaper, $2,000 a month where you're paying $24,000 a year, it hurts. It hurts when you hear it out loud like that. I don't know if you've written it down, but that's something to focus on. So focus on, hey, how can I find maybe a cheaper place to live that's still nice and still in a safe place for my family, right? Can I get a used car instead of a new car, right? Or can I do without a car? Can I ride a bike? Do I live in a city? Same thing with gas and insurance. Can I shop less, right? Do I have a shopping problem? Am I a shopaholic, right? All these different things. Expenses basically is the quickest way to cut down on that. So the next part here is going to be the difference between those two, which is a very, very important part. It's called cash flow, right? So cash flow is kind of the genesis or the beginning of wealth, right? If I make $2,000 and I spend $2,000, I have $0 and I don't put myself in a better situation moving forward. But now, if I have my income, let's say it's $2,000 here from the example, and my expenses are $1,000, right? And it's red, so we're going to pretend like that's negative and not a typo. So it's 2,000 minus 1,000, right? Gives us $1,000 in cash flow, right? So now with that cash flow, we can put that into investments, which will then make us more cash flow. So we'll still have $1,000, but maybe that $1,000 we invested in something that gets us, let's say 10%, right? So 10% of that is $100. So now I have my $2,000 a month plus whatever the monthly portion of what I invested is. So maybe it's $2,100, or $2,010, or whatever it is, right? It's more, and we're growing, and then that just starts to snowball, right? So the higher you make your cash flow, the more money you will have to invest and pay off your debt, right? So raise your income, which is what we went over, lower your expenses, increase your cash flow. So this is probably the most boring slide, so I will try to get through it as fast as possible. Probably should have put a picture on here for you guys. But interest rates, right? So interest rate, essentially, think about it like this. Someone is lending you money. When you are borrowing money, you are paying the interest rate. So if you have a car, right, and there's a 5% interest rate on that car loan, that means that you're paying your portion of whatever that loan is back. So let's say it's a $5,000 loan. It's a 5-year loan, and it's got a 5% interest rate. That means you're paying 5% of that $5,000, right? Which is $250. You're paying every year just in interest. So that $250 that you're paying doesn't touch that $5,000, right? So you're paying, that's why your car payment will usually be a little bit more than that. So you're paying down a little bit of that $5,000, but you're also paying down a lot of it is interest, right? And so interest is basically money that they're charging you for not having the money to buy whatever it is. So they're saying, hey, I'll give you this $5,000, but I'll tell you what, you're going to give me $5,000 back, and you're going to give me an extra $250 for my troubles, right? For me not being able to use my $5,000 there. So that's kind of how banks work. If you were to lend somebody money, right, and there's ways to do that, a lot of, personal people like private equity and whatnot, they'll lend their own money for a promised interest rate or return. And that's kind of the same thing. So a rate of return, a return on investment, is how much your investment changed in value divided by the amount initially invested, per a certain time period. So if you invested $100, right, and you got a $10 return, let's say a stock, just make it super simple. Let's say a stock went up $10 to $110. That means you gained $10 over the course of that year. $10 divided by the original $100 is a 10% return on your investment. So when I talk about the S&P 500 and I talk about different rates of return or return on investments, that's typically what I'm talking about, is how much percent of the money that you invested did you get back in that year, right? So that's going to lead us kind of into the next things, which is going to be the last slide was the least boring. This is probably the least fun, right? Because it's debt. Everybody hates debt. Debt sucks, right? So what do we do about debt? So the biggest thing I want to start off with kind of before anything is credit cards, because there's a lot of different ways to play the game, right? And it depends on maybe how much education you have in a particular area. But the main gist is that you cannot pay interest on credit cards unless you've got some incredible reason of how you're going to get higher than an 18 to 22% return, and you're using credit to do it. Then call me after this. I'll give you my cell phone. I want to hear what you're doing, right? So 18 to 22% means that if you have $1,000, right? Let's see if I can bring this pen out here. So if you had $1,000, oh, all right, hang with me. Let's see if this works. $1,000, right? Sorry. $1,000, right? That's a dollar sign just for everybody. If you have $1,000 on a credit card, that means over the course of that year, right, you would be paying roughly $200 just in interest, right? That doesn't, this number right here stays the same, right? And it will go down a little bit because, like I said, what we'll be able to do is you're gonna be paying back a little bit more than that. They're not just gonna charge you the interest, right? They're gonna charge you a little bit of the. So the next month, this $1,000 might be like $970, right? And your interest payment on that would be, usually your interest payment per month, right, is this divided by 12, right? So if you have $1,000 and the interest rate is 18 to 22%, this is 20% right here. That's why I use this $200, because this is 20% of this number right here. So at the beginning of the year, let's say you have $1,000 in credit card interest, you will be paying 200 divided by 12 per month in interest, and at the end of the year, that will total obviously $200. So how does that compare to other loans, right? Home loans, auto loans, car loans, student loans, right? They're typically, it depends on a few things, which we'll go over later, but it typically is in that 3 to 7% range. And I see a quick question. I said I wouldn't answer to the end, but I'm going to answer real quick just because I've seen it. I'm going to try to get the slideshow available in some form or fashion for you guys. Like I said, I'm still kind of learning all the gist and whatnot. I'm recording. I hope I'm recording. That's the worst part when you record a show and then you're on vacation or something, you come back and you don't record it. But I think I'm recording right now. We will see at the end, and I'll let you guys know. But so the difference between credit card interest rates and, like I said, car, home, student loan are astronomical. So like I said, the difference between this is if you had that same $1,000, right? In credit card, we determine it's $200 per year. If you have $1,000 in a car loan, you're going to be paying $50 a year, right? That's 5%. We're assuming 5%, which comes from this number right here. So that's why we really want to avoid credit cards probably altogether for a lot of people. Obviously, you can use them and you can rack up points, and you can use those points to travel or to get cash back or whatever. But if you don't pay that balance in full at the end of each month, you will be charged that interest, right? So typically they give you a month. So you have August, and then you pay that off like mid-September or so. If you don't pay that off, then that next month you are going to be getting charged interest on all of the money that is on that account, right? And that's just going to happen every month. And there's actually some cases where the interest is maybe even more than the minimum payment. And so you're snowballing the wrong direction, right? The minimum payment, that's why you see people that are just spiraling out of control in credit card debt. It's because they're letting that get away from them. And the minimum payment, it's like the bank is charging them $300 a month, and they're giving the bank $200 a month. So every month, even if they don't spend anything, that interest rate or that interest is continuing to rise and rise and rise. So what's the difference? Why is credit cards, or why are credit cards so much higher? Well, it's mostly with debt. There's some other factors, but it's mostly the perceived level of risk, right? So why would a home be not risky? Because guess what? You got to have somewhere to live. So if I'm going to pay something off, right, it pretty much would go in this order. Like if I was anybody, this isn't me giving advice. This is saying like, just like kind of common logical sense. Like I'm going to pay my home first because I have to have somewhere to live. And then I'm probably going to pay my car second because I have to drive to work. And then I'm probably going to pay my student loan, same reason, because I'm trying to pay it off. But credit card, well, you essentially are using a credit limit, which we'll go over later. So I'll kind of save this for later. But the basic gist is it's a lot more risky for the bank to give you money on a credit card, because why would you pay that back? Like if you got in trouble, which is what they're thinking, they're going, all right, I'm charging them this because of the risk. What is the risk? The risk is them not getting paid back. So the risk on a home, so it's always high, right? People foreclose all the time, but on a home, they know you're going to pay more than likely because you got to have somewhere to live, right? Unless there's just some absolute crazy thing going on, like pandemic, right? But the credit cards, they're astronomically high. Stay away from it if you can. If you're responsible and you can pay it off the balance in full every month, there is a way to take advantage of the points, but you just got to be careful, right? And the last thing I'm going to say about it is sometimes people, when they don't have cash in their hands, right, or they don't have a debit card where they see the money coming out, it's kind of a psychological thing. So if you find yourself, hey, it's a piece of plastic, I've got a credit limit of 20 grand, even if you're paying off the balance, you got to ask yourself, am I spending more money because I have this piece of plastic that it gives me unlimited money? Because if you're paying more money, if you're buying things that you wouldn't normally buy, just because you feel like you have more money, which isn't your money, you're borrowing it, right? And there's a time and a place for it, but you're borrowing it. So you got to ask yourself, am I spending more than I typically would? So that's kind of my thoughts on credit cards. So as you see down at the bottom, best advice for most people, pay it off immediately and avoid it at all costs, unless you're responsible enough to do so in a way where you're not spending more than you typically would and you're taking advantage of the points. So this is another thing that I'll go into a little bit. I don't want to spend too much time on it just because I'm going to go into I'm going to do a real estate one of these because that's kind of its own monster. But so like a typical auto and home loan rate. So I'm going to pop off to the internet here real quick. Oops. Let me go back. I'm going to discard those. So you guys can still see the screen here. So I'm just this is like my thoughts on auto loan. So this is bankrate.com. They've got a lot of great calculators. Honestly, if you guys are ever wondering, like, hey, like, what's my car payment going to be? How much can I afford? Literally, all that stuff is on Google, and there's people that, if you're thinking it, then a million other people have almost said thunk it. We'll go with thunk it, right? They thunk it too. So you can find that on bankrate.com. I would just Google, auto loan calculator, home loan calculator, paycheck whatever it is, and there's a lot of awesome tools online. So in this situation, we can kind of see, how much are you looking to borrow, like for a car loan, right? We can put in 20,000. You can mess around. Hey, I could pay it off sooner, right? You're gonna get probably a lower interest rate because there's less risk, right? Because if you're gonna pay it off sooner, so then you'll see your car payment, right? And if it goes down to 5 months, then your car payment's going to go down lower or 5 years, sorry, it's going to go down lower because you're paying it off over a longer period of time. So one thing I want you to watch while I do this is watch that total interest paid over there on the right. So if I pay this off in 36 months, yeah, my car payment is higher, but my total interest paid is lower. The only reason why it is higher, right? See how it goes from 582 to 359 for the monthly payment. But watch the interest. It's going to go from 938 to 1562. That's because every year that you're adding on, you're paying more interest on that loan, right? And so you'll see new versus used. You can put in your interest rate or find a rate based on your local area. It's going to take into account your credit score and all that stuff too. But for auto loans, these are kind of average terms, and you'll kind of see, like I was saying, that it's going to go, the lower rate is, you're going to get a lower rate of interest for it being paid off sooner, right? Because the longer it goes on, the more risk that maybe something happens and you can't pay it back. So that's typically why the interest rate will be higher. But you can kind of see and mess around with this stuff and, compare. And like I said, I mean, used cars, obviously the way to go, something that's 2 or 3 years used. It's got 20, 30,000 miles on it, but it really just depends on how long you're going to use the car for, how long you're going to keep it. And then, yeah, it's going to come down to, hey, if you make $2 million, if you make $2 million a year, you may or may not be in here, but, if you want to go buy a car for $50,000, then you go right ahead and do that. But if you're not, which I'm not in that category, maybe one day, but then we got to be looking at all these decisions that we're making, because little numbers and little factors like this can make a big difference, in the money that we're building up over time. So the next one is interest rates, which is here too. Another cool calculator, same kind of thing. And you can find this on your probably on your mortgage website. Like if you have a lender and that has like a website or an app, you can mess around with these. But what it will do is, like, if you put in like your house is $300,000, right? So now I want you to watch the total interest paid. So it's going to say, all right, you paid $247,000 in interest. So that means over the course of this 30-year loan, which is typical for houses, your house costs $300 minus your down payment, right? So the house maybe is $350, maybe you put 50 down, I don't know, right? But this is the loan. This is how much you didn't have, right? So that means that you borrowed $300,000, you paid that $300,000 back after 30 years, but you also paid back $250,000 in interest. So you paid back about twice as much as that home cost, you paid in interest, right? So now watch this. If we move this to 15 years, right? Let's see what this does to the interest, right? So if I calculate that, you just cut that interest, I mean, obviously, in half, right? Because you cut the amount of years in half. Now look at this. So if you get an interest rate and it's, let's say you got, bad credit, and I don't know, you probably wouldn't be this high right now, hopefully, because they're pretty low. They're lowest they've ever been. But let's say you're at 5.5%, right? Your interest paid on that loan will be about $140,000, right? So now let's say you got a 3.5, you're like, oh, what's the difference? It's like 2 percentage points. It's nothing, right? But over the course of 15 years on this mortgage, you just cut your interest. You just cut the interest that you paid almost in half, right? That's about 40% off. So your interest rate that you get on there, how fast you pay it off, how much you borrow, what your monthly payment is, all that stuff, really will help you, try to narrow down, making a good decision and all that kind of stuff. So the next thing that we're going to look at here is let's see if make sure I've answered everything on this page. We'll go back to the slide. So everybody should see the screen again for us. Let's see, that's straight. Unseen costs. Yeah, so unseen costs is like the number one question I think I get with houses, for the most part, as far as primary homes, is should I rent or should I buy? And that's honestly not as easy as a question as you think it would be. Most people would just be like, oh, you should probably buy because you get equity. Yes and no. It really depends on a lot of things, which we'll go over, in like a real estate webinar, hopefully in the next month or so. But it's not as easy as you might think. There's some people that I would say you should rent. There's some people that I would say you should buy. And there's some people that decision's kind of a toss-up. It depends on things that, we don't really have the answers to yet. So the next one here is debt and your credit score. So what makes up your credit score? You can take courses online and you can, reach out to the credit agencies and stuff, and all that stuff's good and that stuff works. But these are the fundamental. Like if you do these like 5-6 things right here, and obviously you have to have time, right? So one of the factors is time. Then you will be okay. Your credit score will go up. So the most important things are, I think I ranked them in order here, right? So it's payment history. Payment history is literally, are you paying on time, right? And that doesn't necessarily have to be paying off in full. You can be paying whatever the payment is, but are you missing payments, right? And that's why it's very important to have your bills in order, right? You get credit, car loans, credit cards, whatever it is, you've got to have that like automatically set up to where at the very least you get a notification and then you go make that payment, or you have it immediately withdrawn from your account if you are responsible enough to keep enough money in a checking bill paying account, right? But you cannot miss payments. That is number one. The number two, which is arguably just as important, is how much are you utilizing your credit? And it's actually bad to use too much of your credit, right? You've got to use some of it, to show that you're being responsible with it and you're paying it off. But credit utilization is just as easy, right? So if you have a, let's see if I got this pen again here. So if you have a $10,000 like limit and you spend $2K a month, right, on credit card purchases, that's how much you have. That is 20%, right? Because it's just 2 divided by 10, which will give you a 20% utilization rate. Which that's not bad. It's pretty decent. You want to try to keep it as low as possible. Some things you can do is you can, and this is, it depends on you. Like I said, this falls in that category of you got to make sure that it fits in with who you are. But you can raise your credit limit pretty easily by requesting to raise your credit limit. Like I went on last month on my bank account, and there's literally a button that says request credit limit, and I got an extra $10,000. I am not spending or touching or getting anywhere near that extra $10,000. But what it did on that particular credit card, which is what I typically use because I fall in that category of being what I would consider myself responsible and paying off the balance in full every month so that I can take advantage of the points. But I'm maybe racking up $3,000 or $4,000 a month on credit, right? And that's not clothes and stuff. That can be bills and food and fun stuff too, right? But it's not just like frivolous money. It's money that is within my budget. So when I was spending $3,000 or $4,000 and I had a credit limit of $10,000, that means my utilization rate was like 40% because I was spending $4,000 and $10,000 was my limit. So it was 40%, which is high. It was kind of lower my credit score a little bit. Like mine's in like the mid to upper 700s like right now, and mostly because I'm opening up new loans and stuff for real estate and different things like that. But just by requesting that credit limit, my credit went from 10,000. My credit limit went from 10,000 to 20,000. So that 4,000, I still spent the same, but now it's 4,000 divided by 20,000, which is a 20% credit utilization score. So it broke it down half, which it raised my credit score like 10 or 15 points. But listen to me. do not raise your credit limit if your cards are maxed out, right? Do not raise your credit limit if you think you're going to spend it. Do not raise your credit limit if you're not going to be able to handle the extra temptation, right? And I'm not judging anybody for that. I'm saying that as a genuine friend, because I've seen a lot of people do that. This is all about being responsible, right? And being educated. And if you aren't sure of something, ask me before you do it. But you know, there's these things are power, right? And power can be used for good or for evil, right? It can go either way. You can raise your credit limit, and in my case, it helped me. You could raise your credit limit, and it could hurt you, right? So that's why it depends on what you're doing, who you are, all that kind of stuff. So real quick, derogatory marks. That's if something goes to collections. Obviously, pay your bills on time. Don't go to collections. If there's any other, reasons why you would have a derogatory mark on there, mostly it's just not paying stuff. Age, that's not how old you are, it's how old your credit is. That's why a lot of times, like one good thing that my parents did, they opened a credit card for me when I was 18. They didn't even give it to me. Probably thank God. And they just had like one bill on it, right? And so by the time I was like 25, I had 7 years of credit history, right? And I didn't really do anything. So I had a great credit score from the start. Number of accounts. So that's another thing too. You don't want to just be opening up credit cards just to open them up, because the last two go like inverse of each other. It's kind of funny because if you open up an account, it'll be like, oh, good, you have more accounts. You're more, there's less risk because you have more accounts and we've seen you handle them more correctly, right? But hard inquiries that's a really hard word to say, inquiries, right? So hard stuff, right? They take that when you pull your credit, right? So if you're going to get a loan, you're going to get a home loan, a car loan, open up a credit card, they take one of these things and they pull your credit, right? And so when they pull your credit, that will show up and it's actually negative, right? So it's funny because you're like, I thought you wanted me to open up more accounts, but every time I open an account and get my credit pulled, then my credit score goes down, right? So there's a balance there. You don't want to just don't open up any account like if you don't have a good reason of doing it, right? That's pretty like good common knowledge when it comes to this. So what's a good credit score? You can see here, you want to get up in the 5, 6, 700s, right? 500 to 600 is what's considered poor. That's 1 out of every 5 Americans. Fair is about 13%. So you can see that, what is that? 35, 40% of Americans are kind of in that fair to poor category. But, good to excellent is going to be, 780 to 850 is pretty rare. But you can get up there. A lot of that takes time, right? You have to be hard for me to even get up there because I just haven't been alive long enough. I haven't had credit long enough. But I'll get there eventually. But you should shoot obviously for the good and excellent area. How does your credit score affect your interest rate on loans? I'm going to pop out to the internet here as well. It's probably going to ask me to keep. So where is this thing? Car loan. Okay. So this real quick, this is an example. So super prime, prime, non-prime, subprime, deep subprime. Those are kind of the same things that we just went over. But so it's pretty insane, honestly, because look, so this is an 800 credit score, which is incredible, right? This is rough, right? Depends on a lot of other factors, but for a new car, you have a 3.65% interest rate. If your credit score is 300 to 500, you're paying 15%. You're paying 5 times as much. That's why it's important to get your credit score up before you take out a loan, because guess what? If you're doing a 15% car loan, you're essentially, that's almost a credit card. That's pretty close to a credit card. So the best place to acquire your credit score, which I was going to go over a little bit later, is Credit Karma is a good app. Which, if you don't know it's like credit and then like karma, right? That's a good app to download. It should give it to you for free, and it will actually. You just gotta be careful on that. I'll go into that a little bit later, I promise, because I put it on there. I specifically for this, and here's the part where my dogs probably start to bark. But this will show you, hey, look, here's how incredibly it will affect you, depending on what your credit score is. So getting it up, if you're at 580, getting it up to 620, 630 could mean the big difference, right? And we showed you earlier how much 4% can mean. It can mean on a mortgage or on a car. That could mean hundreds, thousands, tens of thousands of dollars, right? So we want to make sure that we're, paying attention to our credit score. So debt and your credit score, how can I improve my credit score? So I kind of went over how to improve it as I explained those. So basically pay your bills on time, use it less and raise your limit if you can, if you determine that's a good idea for you. Pay your bills on time, be patient, I guess. Pay your bills on time. This is kind of be patient, right? You're going to open up accounts over the course of your life for different reasons, but don't open up accounts just to open accounts. And then these hard inquiries, basically they should be taken off your account after like 2 years, because you can't just keep getting penalized for opening accounts, right? Because that would make no sense. See my dog back there? He just hopped up on the bed. So the next part is banking accounts, right? So savings and checking. So checking accounts, obviously, they're basically just cash, right? It's basically, you might as well have it on your mattress. They do serve a purpose because we live in a digital age. You've got to have a checking account. But this should really be for just super liquid. What I mean liquid, I mean like cash that you've got to use now, right? Like obviously you can't invest in index funds and use that money to pay your bills every month, right? Because you'd have to be buying it, selling it, waiting. Like you need your money now, right? So checking account, you want to keep money in there for like your bills, things that you're paying off immediately, and then, so that's the uses. The downside of checking account is any money that's in there is you're not earning any money at all on it. So it's basically just like if you had, like I've had friends that are like, oh dude, yeah, I had like, 40 grand on my checking account. And I'm like, okay, well, do you need it like tomorrow or something? Like legitimately asking. Like, oh no, like I don't really know what to do with it. I'm like, oh my God, how long has that been in there? Like, that 40,000 in 5 years or 10 years can be 80,000, 100, who knows, depending on what you have invested in. So checking accounts, think like this month, really, savings accounts, you can open up, I mean, you have to check with your bank, but a lot of times you can open up like multiple savings accounts with no extra cost. So you want to make sure, obviously, you're not getting charged fees and stuff when you open them up. But what some people will do is say, hey, I'm going to open up a savings account for my wedding. I'm going to open up a savings account for my my house down payment that's coming up, right? So you could invest that money, but obviously you're just taking more of a risk because the stock market or whatever you have your money invested in could always go up or down. So savings account are more for like, hey, I need this money within like 3 months, 6 months. And it's all based on your risk tolerance. Like if you were saving up for a house down payment, you're like, I don't care about making any money on this. I just need this house payment in the next 2 years, or my life's going to be over for whatever reason, right? Which that's your decision to make, and there's no right or wrong answer to that. But if you're like, hey, I got to have this money, I don't want anything happening, but I don't want it on my checking account where I spend it, what you can do is open up a savings account, and you can put it in there, right? So you just don't touch it, and your debit card comes out of your checking account, so there's no real way to access that savings account unless you transfer the money. Some people even will take their savings accounts, they'll open them up in online banks, but they or like credit unions or something like that, where they don't even have they're like, look, I don't even want to see this account. I don't want to know this money exists. I can't handle having this extra 5,000, which is fine, because honestly, it's more impressive if you do that, if you know that you are like that, right? So it's all about, like I said, going back to being aware. So some people will open up savings accounts, which they typically get a few more, slightly, I won't say a few more percentage points, but they'll get a little bit more interest, right? So checking account is like next to zero, right? So if you have $10,000, that means at the end of the year, you're going to have $10,000 in there. Savings accounts, a lot of people focus their time on this too, like, oh, I need to get 1% instead of 0.75%. Yeah, yes and no. Like the difference between 0.25% on $1,000, I can't even do that math. I think it's like 20 bucks. I don't know. You know, like it's over the course of a year, right? So, you know, it depends on how much money you're working with. In my mind, it's just not even worth it to hunt down like this or that. But if you got to have your money somewhere, and you know you're going to keep it in a savings account for 2 or 3 years, you know, maybe you want to look into something and make sure you're not, you know, make sure there's something that maybe you're going to get 1.25% or 1.5%. Those are called high yield savings accounts. You can Google that online. We would kind of go into that at another time. And I'm going to do another webinar as well on investments, just because that's its own category as well. But that's checking in savings accounts. So as you can see, we've got income, we've gone to expenses, right? And this isn't necessarily in any order, because you know, really what I'm going to say at the end is you should not pay your investments first, but you should make it to where, because what you're going to do is you're going to go, oh man, like I was planning on putting $200 in investments, but you know, I ended up spending more and paying more of my debt off and savings and, you know, all that different kind of stuff. So you got to make room for your investments, because, you know, people think like, okay, once I get to this much money or whatever, then I'm going to start investing. But you don't get to this much money without investing for the most part. So you want to start now. There's no dollar amount that's too little. You can, you know, you can invest in fractional shares a lot of places, right? Which would mean like, you know, obviously if you can't, you know, maybe buy an Amazon share that's $3,500 and that's what you've determined is a good investment for whatever reason, then, you know, you can buy fractional shares. You can put like $500 in and get 1/7 of a share. Is that worth it? I think money invested is always worth it, because somebody might come to me and say, hey, you've only got $400,000 or $500,000 invested in the stock market. That's nothing. Why do you even have that in there? I mean, you know, we could always play that game. You could always just say, you know, there's always somebody that's got more. So I think that building these foundational principles, because you know you're going to need it later, why not set yourself up now so that you're prepared when that time comes? That's my opinion on is any amount of money too little? I don't think that there's an answer to that. So investment accounts, like I said, we'll go over this more in a future depth, more in depth in a future webinar. But there's retirement accounts, you know, which are 401k. 403B, which is specific companies have those. IRA accounts are individual retirement accounts. You know, and you got the whole, I'm sure you guys have heard Roth and traditional. So we'll go into all that. I just want to have this here just because it is an important part of the financial plan. Like I said, it's so much its own category that I don't want to just go into it so lightly and not do it justice. But there's retirement accounts, there's taxable brokerage accounts, which are just your typical, you know, like Robinhood or Merrill Edge or, you know, TD Ameritrade, E-Trade, you know, any of those typical like accounts where you go buy stocks. That's all a brokerage account is. A high yield savings account we went over. It's just a savings account that typically has a higher rate. Health savings account is very specific. It's related to, it's got some things to do with like kind of your insurance. It depends on what kind of insurance you have, but it can be a good tool to build tax-free wealth for medical related expenses. And then also there's the minors question, right? There's 529 savings plans, which will allow you to invest money for a minor, and then, you know, they can take it out, you invest it, right? And then, you know, whatever money you put in plus whatever money it accumulates over time, you're able to tap into that later. And as where in a brokerage account, like if I sell my, you know, index fund stock or whatever it is, I'm typically going to have to pay taxes on that. I don't have to pay capital gains taxes on that. For some of these other accounts, like your retirement accounts, some of them, health savings account, if they're for qualified medical expenses. And then the last one, if they're for qualified educational expenses, for like a minor or whatever, like for instance, you would save up for 18 years. Once they get to college, they'd be able to pull that money out and no one's paying taxes on it. And they could use it for educational related expenses, which are like books and tuition and stuff like that. But, you know, maybe there's a lot of, that's what I'm saying. I'll go into it more in depth later, but yeah, maybe you don't want your kid to go to college or whatever. You know, it doesn't mean that you lose that money. You just probably have to pay taxes on it, pay a penalty. in that regard to tap into it. So it's not a bad thing to have, but it depends on what's going on in your life. So taxes, I think I said another one of these slides was the lease fund. This is absolutely the lease fund. I get it. We got to pay taxes. We got to contribute, but it's not fun. Nobody likes their money getting taken. But real quick, this is a post I made earlier this year. So taxes, if you fall in the 22% tax bracket, so you can refer to the infographic on the right, that doesn't mean you pay 22% on all 50,000 of that salary, right? That means that it's what's called a marginal tax system. So you'll see here that let me pull this laser pointer thing out. All right. So right here you can see from $0 to $9,500. Even if I make 50,000, right? That first $10,000, I'm only paying 10% on, right? And so this is how much that comes out to. And then that next bracket, right? That next marginal tax bracket, right? Everyone hears the term tax brackets. So now I'm paying 12% on that next, just the amounts that are in between these two numbers. I pay 12%. So if you calculate this number, right, it'd be like 38,000 minus 9,000. It's about $27,000. So 27,000 times 0.12 is going to bring you to that amount. So then on that last portion of the $50,000 be 12,000, about 12,000 times 22,000, times 22% is going to give you that number there. So instead of the most you paid was 22% on this last bit, right? But the actual tax rate you paid was about 13%, which is a lot better, right? So you paid about $6,000 in taxes. So taxes, a lot of people don't understand, but taxes are, when people get a break, right? Not a break, when people get a refund at the end of the year, it's not like necessarily they did anything like better or worse than you did. This number right here, this $6,945, like the IRS knows you made $50,000, and let's just say you didn't have any withholdings or whatever, or deductions or children or any of that other stuff, right? Just super basic. Then the IRS goes, hey, she or he should have paid $6,945 in the year. So if that number, for whatever reason, is higher or lower than that, then they are going to either give you that back to match $6,945, or they're going to take whatever from you until they get $6,945. So there's no real like, oh man, this guy got $5,000 back. That just means that he paid $5,000 too much in taxes throughout the year for the most part. Now there's a lot of factors that go into that. And you're like, okay, how does somebody pay too much in taxes? Well, you could have these deductions, right? There's a lot of reasons why you would get deductions. Like if you have a mortgage and you pay interest on that mortgage, like we talked about earlier, typically that's tax deductible. So if you pay $15,000 in towards mortgage interest every year, then you don't get $15,000 subtracted from your taxes. You get $15,000 subtracted from how much your taxable income is. So if you made $100,000 a year, to use easy numbers, and you had a 20% tax rate, we'll keep it simple. That means you paid $20,000 in taxes. So if you paid $15,000 in mortgage interest, that wouldn't mean that your tax bill would go from $20,000 to $5,000. That would mean your taxable income goes from $100,000 down to $85,000. So then you would take 20% of $85,000, and so you would end up paying a little bit less in taxes, right? So that's kind of how deductions and tax breaks and all that stuff work. But you also got to take into account that there's federal tax, state tax. Sometimes, Florida doesn't, Texas doesn't, like California does. It all depends on your state, but typically, like in California, like in Los Angeles, I believe, if I'm not mistaken, there's tax, California tax, Orange County tax, and Los Angeles city tax. And then you also have Medicare and like Social Security, like FICA and that kind of stuff, taking out your check every week. So there's many strategies to lower your tax bill. But what I recommend, people talk about building their financial plan, saying, oh, well, I need, I use my gross income, right? But that doesn't really help you, because why wouldn't you just use the money that you're actually going to get, which is your your after-tax income, right? Like why would I use $50,000 as an example when I know I'm going to have to pay $7,000 in taxes? I'd rather, work in where I'm going to be using $43,000 and then going from there, right? Because then you're going to end up and then like, I don't have any money to invest, right? Same thing, but it's because you didn't factor in taxes. So here's a big question. This is kind of what we've been building up to. So here's an example spending plan. This is what I would consider like normal. If you're trying to get aggressive or maybe you don't have debt or whatever, obviously you have to change these things. But 35% on housing, typically that's the norm. These are all kind of the norm, but this is not going to get you in a really good place really fast. This is at least going to be like the bare minimum, right? So some people are spending 50% on their housing and 25 or 30% on their life and 15% on their transportation, which includes like your car and all that, 10% on their debt, and then 0% savings, right? So these are numbers that you can go ahead and calculate for yourself, right? And just say, hey, add up all those numbers. What you can do is, if you do use a credit card or a debit card or whatever else you might use, you can go on your bank app or I would suggest going on a computer. You open up either your statement for the month, or there should be a button that says export to Excel. And even if you're not great at Excel, you don't have to be. It literally just shoots it into Excel, and it's just a bunch of numbers. And if you don't know how to do make a sum in Excel, you literally just go if you have that question, let me know and we'll work on that. But it's super simple. I'm not just saying that. You can shoot all those numbers in there, and what you can do, what I do sometimes, I don't do it every month because it's a lot, but every few months I kind of see hey, where am I at? Where am I spending money? So I'll download my credit card to Excel, and then I'll insert a column, and I'll just there might be, I don't know, let's say there's 40, 50, 60, whatever, however many transactions throughout the month. So I'll make a column, and then I'll look at it, and I can tell what it is because it will be gas station, restaurants, or AT&T, whatever it is, and I will put it in a category. And I try to make it as few categories as possible, right? I don't want to be but make as many categories as it makes sense to, right? So a reason why I would say that is don't just put food, right? Because there's not just food. There's groceries. There's fast food, like eating out food. And then there's restaurant food, which is extremely more expensive. And then there's the bar, right? Or whatever, right? Different things. So that would help you because if you might say, well, I'm spending too much specifically at a bar, or I'm spending too much specifically, I'm going out too much at restaurants, or hey, I'm spending $600 this month at Chipotle, Dunkin' Donuts, and McDonald's, right? Or whatever it is. So that you want to break it down to as few or as many categories as you need to kind of see where you're at. So here's an example. This is another example. And the first thing is don't say this is unrealistic because this is somebody that I know. It's not me necessarily. It's close. I'm probably pretty close to this, honestly. But that's what I'm saying. So look at the difference. The saving and investing, right here. The saving and investing, went from 10% to 40%. So what does that mean? Does that mean I have to sacrifice? Does that mean I have to, I don't know, what everyone thinks, live in a cardboard box or whatever it's going to take to do that? No, not necessarily. But, what it does mean is that we can kind of maybe make some sacrifices in some areas. Maybe we're spending money on things that we don't even want to spend money on, right? Or that we don't need, right? So we've got to look into our Excel, see where that might be, make some adjustments, and we're doing this based on what your goals are. So if you tell me, hey, I want to be retired in the next 5 years, 10 years, 15 years, right? Most people probably don't. That's fine. But if you want to be aggressive like that, then you need to prepare to, save and invest that much money. So, like I said, you can kind of make your own or find somewhere in between. Everything's different for everybody. A last couple of few examples of different definitions I wanted to go over with you guys. So an asset versus a liability. So this is how we build what's called our balance sheet and calculate our net worth. So an asset is a resource with economic value. So think something like cash, right? Cash is an asset. Your investments, your stocks, your real estate, equity, right? Which means how much of the house do you actually own? And then liability is anything that's negative, right? So if you owe somebody money, right? If you pay $10,000 down on your car and you still owe 10,000, or let's say you owe 15,000, make the two numbers different, and that $15,000 would be a liability. Same thing with your house. And then an income producing asset is a little bit different. It's kind of like what we went over earlier, like a dividend stock or rental property. So that's going to produce income that is both consistent and easily accessible. So the difference there is, like, if your primary home, it's not an income producing asset. It's an asset. You have money in there. It's not necessarily a liability unless, you have a mortgage. So it's kind of an asset and a liability, but a rental property, right? Yeah, technically you might have a loan on that, but if you're making more money than that loan, then you have an income producing asset, right? So even after you pay the mortgage and whatever it is on that rental property, you have money coming in. So that asset, that house that you have equity in, is giving you money or cash flow, like we went over earlier, every month. So your net worth, right, is assets minus liabilities. So you'd want to write down how much basically is everything worth that I own. Right? And that might be one thing, that might be 0 things, that might be 100 things, right? So no one's going to see your sheet. I'll look at it if you want me to, but it's about getting real with ourselves and just understanding where we are, and becoming aware of that so that we can build upon it. So like I was saying before, your home is worth $200,000. Technically, you have a $200,000 asset on your balance sheet, right? But if there's a loan, then on the other side of that balance sheet, you would have $140,000 in a loan, which would be negative. So that $200,000 minus the $140,000 that you still owe on that, that would leave you with $60,000 in equity, aka that would be your net worth if let's say for whatever reason you didn't own anything else. So I want to go into some action steps. We're kind of starting to wrap up. Homework, right? So this is good homework. This is homework that makes us rich, makes us more wealthy, makes us more educated, right? So define your financial goals. So I know I went over those earlier, right? Like, how old are you? Where are you at? What kind of money do you have? When do you want to retire? What does retirement look like to you? How much is that going to cost? How much do you need to save? All that different kind of stuff, right? If you need help with that, let me know. And that kind of goes hand in hand with your assess your financial situation. So obviously assessing is, I guess, kind of more so what I just went over. Just taking a look at all your different stuff, right? Write down your income, write down your expenses, how much is going to savings. Make your own little pie graph, like I said, and print out your Excel sheet and, write by hand or write on the computer and see, hey, where am I at? What can I do? Where can I make some changes, right? And then take that money that you are now saving because you didn't know you were spending and use that to invest. So like, again, and then your goals, right? So your goals are a little bit different. Where do you want to be? How do you want to get there? What does it look like to you, right? Because everybody's retirement's different. Or whatever you consider to be retirement, right? It doesn't mean you have to be 65 and playing shuffleboard and whatever else. It could be literally whatever you want it to be. But you need to be very definitive and specific in your intentions that you set, because otherwise you won't get there, right? So if I'm not intentional with my goals, if I'm not intentional and specific with where I want to go, then obviously you can't expect to end up there. Find out your credit score. So earlier I was talking to John. So look up Credit Karma app. It's super, super easy. Get your banking app. All these apps, right? I have a finance, like the little folder on my iPhone, right? And it's, my investing apps, Bank of America, my stock market app, my different investment accounts and all that different stuff. So do all that. Write down all the questions you have and dedicate 1 to 3 hours per week or more, Googling, reading, YouTubing, asking somebody, whatever it might be, 1 hour per week. Like, come on, you know what I'm saying? Like you guys are probably the ones I don't have to talk to, because here you are spending an hour on your Wednesday night, which I'm so grateful for. But keep it up. You know what I'm saying? Like, doing this PowerPoint is going to get you guys, I hope it's giving you a lot of great information, but this is scratching the surface, right? So we got to make sure that we're going to continue on a good path. So here's some apps and resources. The Credit Karma app. Download your mortgage lender's app, your car dealer loan app, your bank's app. Start figuring out what these numbers are. What's my interest rate? How much am I paying? What's my payment? If I make an extra payment to my mortgage or my car or whatever, how would that change the life of my loan? Investopedia.com is a great source. If you can literally look up anything. All those calculators I used earlier, most of them are on bankrate.com, but if you don't remember, just Google auto loan calculator, home loan calculator, all that stuff. Here's some great books as well. The Millionaire Next Door. Basically, that will show you that all millionaires are not driving flashy cars, and which if you want to do that, then drive flashy cars, right? But I want people to know and understand that that's not what most millionaires are like. Rich Dad, Poor Dad, I'm sure most of you guys have heard of. It's a good book about income producing assets, which is basically saying, I'm going to get my money, I'm going to put it into real estate or stocks or businesses or these kind of things that are going to produce money for me, so that if for whatever reason, knock on wood, I cannot work or I do not want to work, I don't have to work, right? My money is going to work for me. The Richest Man in Babylon is another classic. The biggest thing there, there's a lot of great lessons in that, but one of my favorite is, make sure that you're paying yourself first. Make sure you're investing, investing first, right? So you want to say, hey, how much do I want to invest every month, right? And you determine that by, figuring out, hey, how much do I need to invest? How long am I going to be investing? What interest rate or what rate of return am I expecting? So if let's say it's $200 a month or $100 a month that you come up with, or whatever, you can start at $20 a month and work your way up. But don't let that ever go lower, and continue to assess that and make sure that there's not a situation where, oh man, these unexpected expenses came in, so now I'm going to have to lower my investments. It should be like, I'm making my investments no matter what. I don't care. I have committed to $100 a month, whatever it is, and there's nothing else that is going to get in the way of that. So the other one is Money Master the Game. Tony Robbins is obviously the GOAT, the greatest of all time in a lot of different areas. He's got a lot of stuff on mental mindset. He does a lot of this is a crazy word. I can't believe I'm actually saying this out loud, but neuro-linguistic programming, which is basically things like affirmations and, mindset and spiritual type stuff. I mean, he's if you haven't heard of him, he's a huge influence on some of the greatest minds in the world, but he's also got a great book about money and investing and compound interest and all that kind of stuff. So personal, these are some of my personal best Instagram accounts for personal finance. So the first one's Personal Finance Club, which is a guy named Jeremy. I've talked to him a few times. He's a real cool, down-to-earth guy. I mean, he's really I've even listened to his accounts or his podcast on kind of how he grew his account from basically zero to it's like 120,000, I think, today. In I think a little over a year, which is just incredible. And it's really nothing special. He literally just puts out great content, which is how I ran into him. And he's basically, he is a mid-30s retiree, and now he's kind of passing along his tips and tricks when it comes to investing. A lot of it's index fund investing and just basic sound foundational kind of like stuff we went over tonight. Great guy to follow. And also the Real Money CEO, which is a guy named Ryan. I've also spoken to a few times. Real great, humble guy. That's the thing with this, with Instagram. There's so many great people that you meet. The next one is really incredible. It's My Wealth Diary, and I don't know who she is because she does not have her face and her name on there and stuff. It's kind of like an anonymous account, but she's got 25,000 followers, and for good reason, honestly, because if you go to her account, check out she's got Excel sheets that literally, I mean, I would consider myself pretty good with Excel, honestly, and the stuff that she has, I'm like, whoa. I'm like, that's just next level. She's got basically everything all worked out to where you put in here are my expenses, here's how much it is, how much I've spent this month, here's my investment accounts, here's how much in there. And it will make it really aesthetic, really pleasing to the eye. it shoots, like makes graphs for you. It shoots fireworks, maybe not the fireworks, but it's honestly no joke. It's really incredible. Some of the stuff on there, and she actually sells them. So like, which I didn't know this was a thing either, but you can click on the link in her bio. I'm not getting paid for this. I literally just think that that's awesome. And then it will go to her Etsy store, which is just an online site. I think it's like 25 bucks, and basically she'll give you like the code or however it works. And then you open up, put your own information there, and that way it'll help you keep track of all your stuff. So the other last thing, or last guy I want to mention to you guys is Mr. George Pitts. So George has actually helped me. He's the one that helped me not create like this PowerPoint and everything, but dude, I mean, there's so many things, because like there's knowing personal finance, investing in real estate and all that stuff. But then there's like, how do I share this, right? Yeah, how do I do all this stuff? And as far as like Zoom and filming the webinar and email lists and all that stuff. So all that stuff I was completely green on. So he helped me do all that. He also has a great credit repair course that would help out a lot of people as well. So real quick, my financial rules to live by. If I was being honest, this would be like 50 slides, but I narrowed it down to one. Live below your means, and not live below your means, live well below your means, right? So that means if you make $1,000 a month, live well below that. Spend much less than that, right? Because that gives you flexibility in case something does go wrong, and it allows you to invest more money, in any situation. And the more you invest, I mean, obviously the better your life's going to be. It's kind of the point of this. Start investing early. If you haven't started, start now. Like I said, it doesn't matter how much money you have, just get started. Stay consistent. That's another thing. $100 a month is great, but when you do $100 a month for 1 year and then something happens and then you wake up and you're 45 years old and you forgot to do it, then that's not good, right? It comes from consistently committing to taking action on a daily or monthly basis. Keep score. How do you expect to win the game when you don't even know the score? Keep track of your financials. So, don't go overboard with this. Don't let any of this overwhelm you, right? Because you can't get more information and feel worse, right? So, but a lot of times people, we went over a lot tonight, but a lot of people might say, well, I got all this stuff to do. Take it step by step. If you wouldn't have done this, you would, like, ignorance would be bliss. You wouldn't have even known that you needed to do any of this stuff. You know what I'm saying? So don't like beat yourself up or say, I got to get all this stuff done. That's my problem. So do as I say, not as I do. Try to do everything, as soon as possible. But keep track of things. Start by tracking your income. Start by tracking, do the Excel thing we went over. Start by doing the homework that we went over, right? Don't harm your own financial situation by spending all your money to make it look like you are rich or to impress people that maybe you don't even care about, right? So that's a big one. Spending money on, I'm not saying don't spend money, right? I'm far from that. I say spend money on the things that you can truly more than afford and that you have decided bring a level of value in whatever manner that might be to your life, right? If you've decided that's important enough for you to spend money on and you need that new shirt or you need that new whatever it is, go for it, right? But you've got to be able to make the decisions on your own and say, hey, how much money do I have? Is this the best decision for me? Is this providing me with enough value? Like my coffee or whatever. Like, okay, $5, whatever, I'll eat the cost. Like, without my coffee, I'm going to be making a lot less money and be a lot worse financial situation if I don't have my coffee, right? So it all depends on what you feel is important that you need to spend your money on. Anybody at any age, in any situation, can always make their situation better, right? So you must believe that whether you think you can change or you think you can't, either way you're right. So it doesn't matter if you're 6, 16, 60, doesn't matter, right? You can always make your situation better. We can't go off comparing ourselves, to me, because guess what? If I compare myself to, there's a million other people that are better than I am, right? So you can always play that game, right? You can always go down that rabbit hole. You've got to say, hey, where was I yesterday? Where am I today? Where am I going to be tomorrow? Is it a better place than where I was in the past, right? So we're just constantly comparing ourselves to the past version or the present version of ourselves, right? We're trying to lean with our what I call forward inertia, right? Forward momentum, right? Every day is one step, right? And not every day is going to be a win, right? Some days are about defense, right? But taking that one step forward, say, hey, I might not have made $1 million a day, but maybe I made $1 a day, right? Maybe I learned something. Maybe I took a webinar today, right? So we're just got to constantly add up those, those points, right? And then eventually you'll cash in later on. So you risk more by not investing than you do investing. And then the last one is finance. For some reason, people avoid it, but it's kind of like, I always think like, hey, if you're a doctor, right, and your body was out of whack, even if you're healthy, right, you would go for checkups like throughout the year, like, hey, like something's like, I think I broke my leg, or like, I think I'm like sick, right, or I need to get, like with COVID, obviously, I need to get COVID tested or whatever, right? That would be a no-brainer. But for some reason with finances, people are like, I don't want to go see someone, right? So consult someone that's their job, square away your finances, right? I mean, a financial coach, financial advisor. You got to be careful. You got to do your research. You got to find people that, are legit. But there's people out there, and maybe for you, maybe $100 a month or whatever it is. Maybe that person's teaching you how to make $1,000, or maybe that person's, maybe you're getting $100 worth of value, right? So don't always think like, oh, that's expensive or whatever. Like if somebody's providing you a service, like, I did this for free, right? So don't pay me money, but someone in here, right, is going to take this to someone else. And who knows, maybe someone starts investing now. Maybe they were never going to invest. Who knows? We'll say maybe at least one person, right? Or maybe one person didn't know how to make a spending plan or a budget, or didn't know about a savings account, right? So who knows how much money this is going to make. So try to think in terms of, hey, what am I going to get out of this, right? So if I pay $100 for this, what is the value that I'm being provided? The next webinar, so getting started investing, it's either going to be investing in real estate, but I think it's going to be investing first before I go into that. So that'll be kind of like part 2 of this. I'll let you know as I get more information. It's going to take a little bit more time just because a lot of these are going to require a lot more in-depth examples and explanations and everything to try to build the PowerPoint and all that stuff. But it's going to be exciting. Going over stocks, bonds, ETFs, investing accounts, getting started, building your portfolio, and then to how to actually buy a stock. So we're almost down to the end. I promise you, I'm going to go through kind of some of my stuff real quick. It's kind of cool to look at. But first, obviously, where you can find me. The really cool thing is I didn't do this presentation that long ago. I think it was like 3 weeks or a month ago, something like that. And I was at 2,800 followers, which I don't know. I'm just overwhelmed, honestly, by the amount of support, and the people that are constantly reaching out, the people I've met. I don't know. I just didn't expect any of this. I didn't expect to be here tonight, and I'm just really really excited and really happy that people are this is something that people want to be a part of. So tonight, we're at 4,000 followers. And I'm just really, really excited and grateful. Sorry, I promise I wouldn't cry. But you can find me on Instagram. You can find me on Twitter. Twitter, I think I have like 10 followers. I usually it's easy to write and then post on my Instagram to kind of get a point across. But maybe I'll build that Twitter up, so follow that if you want. You can email me at definingwealthllc@gmail.com. You can DM me, obviously, anytime. Anybody that says, hey, I was in this webinar, I will drop whatever I'm doing as soon as possible, obviously, and help you out in any possible way that I can. If you like this and you found, I know a lot of people saying thank you, thank you guys for being here. Please share it, man, and not not being greedy in any way. I literally just want as many people as possible to experience maybe what you've experienced tonight. So if this impacts you in any way, like I said, I don't want any money. What I want from you guys is to go out and spread the gospel, right? The good news. I want you guys to spread the message and say, hey, there's hope, right? All we need is to learn a little bit more, right? All we need to do is spend some time. Hey, go follow this guy, or go check me out, right? And they can make the decision on whether or not they want to follow if it finds value. But if you found value, share that with share my post, a few times a week, or send it to some people that are maybe, down and out on their financial situation. Send it to some people that are, whatever, right? Do have a LinkedIn. I do have a LinkedIn, but it's not, I guess it's not really related to my like defining wealth account, but you can like look me up on there. Honestly, I never go on LinkedIn because like for my job, I just don't like, I don't use it. I built it thinking I would. But if for whatever reason, like that's your thing, then you could definitely look me up there and hit me up. So I'm going to go in real quick to, well, first, obviously, like I said, I just said thank you and I just cried. So I'm not going to do that again. But boom, disclaimer, right? At the end, we got to do this. So this may go without saying, but all information within this presentation is not advice specific to you, but rather financial education to help you determine ideas and options that may be beneficial to you. As always, I recommend that you contact a financial professional. It's going to help you work through the specifics of your life to help a financial plan that is best fit for you. So tonight's all about, hey, how do we think, not how do we do? Like what stock do I invest in, right? You know, that's great, but that's not going to help you because I'm not going to tell you. I'm not going to be there with you to buy. I'm not going to be there with you to tell you when to sell. I'm not going to be there with you to tell you the next step, right? So we've got to be able to determine these things on our own. So real quick, I just want to show you guys this thing. So do not be scared when you see this. So I'm going to show you this PowerPoint first of kind of like what I'm talking about. So where was it? So like this, right? So this is like a financial plan, super basic, and you do not under any circumstances have to do what I'm about to show you. But so this is income and this is expenses, debt, savings, and investments. So I went on this it's called Creately, I guess. I had to pay like $5, but I was like, all right, it's kind of worth it because it's pretty cool. So this is like my version of this, right? So you've got like my income up here, and I can scroll into the different areas and stuff, but I've got like my W-2, which has like commission and has, you know, bonuses and stuff like that that I'm able to get. You know, I think this is real estate. Real estate, right? Yeah. So like this is one of my properties, and then within each one of those is like 3 units, 4 units, unit. So it's like 8 units. And then this is like stocks. So stocks that pay dividends. I think this is just dividends, right? So I don't have like the specifics of, I just kind of started creating this and I don't know if I want to go in all the way in depth to like put exactly how much is in every account and all that stuff. Cause I have all that information in other places, but I just wanted like an overview of what I, you know, my plan now and where I tend to take or where I want to take it. Up here, you know, I have defining wealth, right? This is like the real estate and stocks. And then, you know, right now, I mean, I don't have any income coming in. But yeah, you never know. Like, you know, I have a lot of goals and stuff. I mean, I do affiliate sales. I sell some other people's courses through my link in my bio. But I really, you know, I hope you guys have seen tonight. I love speaking. I love teaching. I want to get into coaching. I do have a full-time job, which is absolutely insane. It's like 50, 60 hours a week. It's tough. But I want to get into like maybe one-on-one coaching. I might have some opportunities for that, or group coaching. You know, I want to put out some courses, some more webinars. You know, I want to make some products, you know, some worksheets, some planners, some journals, some things that I use that I've kind of created. And then like I want to speak too, like public speaking and that kind of stuff. So those are like some areas where maybe I hope to make, you know, extra money. So I'm always kind of thinking about that kind of stuff. This stuff is like, what is this? So this is like my bank accounts. Like I have savings, checking, credit card for my personal. My real estate, I have a checking. Like in real estate, you have to have like a non-interest bearing account for security deposits and stuff like that. Credit card, defining wealth. You know, so you want to use business expenses if you can, right? For whatever it is, like tax deductible, essentially. Then I have a couple of different credit cards, which I won't go into necessarily. I mean, basically, this is a credit card my mom set up for me when I was 18, like I was saying. So I have had that. This one was probably like, I think I was on an airplane and they promised me like a free flight, and so I just got suckered, right? So there we go. We're not all perfect, right? This one, what is that? Oh, this is like my loans on my mortgages and stuff. So this is like my rental real estate mortgages, my primary home mortgage, and then this is my truck loan, which I will pay off that truck next month. I'll make the final payment, and I'm going to do a post on that to let you guys kind of know what, why I spent the money I spent on it, why I got a loan, why I got the specific loan, because like I said, it all kind of depends on your specific areas. And then down here is like, probably this is like the most important part as we went over. This is all my investment accounts. So like I said, I mean, don't let this like, shock you or, have any sort of negative impact. Like, this should just be something to kind of say like, okay, and this doesn't mean that this is correct, right? This is what I have determined for myself, that I need to put myself in the best financial situation possible for different particular goals, right? So all these accounts, like retirement accounts, I have a Roth, I have retirement account, and then I sectioned it into Roth and traditional. I've got my 401k, which is my company sponsored. I've got my IRA, which is my non-company sponsored. I've got my traditional, which is my company sponsored traditional, and then my non-company sponsored traditional. I've got a brokerage account here. I've got a different brokerage account. I've got Robinhood, which I mess around with like some long-term stuff in there, and then some like options trading is something that I've tried to pick up more this year. I wouldn't even recommend that to anyone getting started. That's definitely something that's maybe not even necessary, but I think it's got potential, and just so you know, like when I trade options, I'm probably messing around with like 1%, 2% of all the money that I have in stocks. So like kind of keep that in mind. So when you see people that are like dumping like half their account into options and stuff to try to get crazy returns, like they're going to post the good returns, but they're probably not going to post the bad returns. And then I have like really nominal small amount in cryptocurrency, which is like something that honestly, just for speculative reasons, just to have kind of like a little bit of exposure to. But again, that's probably like, I'm trying to think, maybe 1% again, 1 to 3% of what I own. So it's like by no means, and I'm not saying it's a bad investment. It's something that I personally don't, that's just not my lane, really. I guess the easiest way to say it. Primary home and the mortgages associated with it. Investment property 1, investment property 2, and then, like I said, each one of those there's 3 or 4 units. So I have 8 units altogether. I have a lot in Alabama, and then I have a REIT, which is a real estate investment trust. It's kind of more like a stock, like you invest money into the REIT, and then everybody pools their money together through an app called Fundrise, and then they pay you out returns, kind of similar to stocks, but they take that money and buy real estate, so kind of put it in the real estate category. But yeah, that's kind of my categories for now. So I think I have like, I think it was like 16 bank accounts. Like I think 11, 1, 2, 3, 4, 5, 6, 7, 8 investment accounts, and then like, I don't know, 5 real estate accounts. And then up here, I've got 4, 5. I mean, it depends. Like if you count each unit as an income source, then that's 7 or 8 right there. But that's where I get like 10 income sources, because one is a few different sources at my job, a few different sources with the real estate units, stocks, and then like this account. Like I hope to build it up and speak and grow and all that stuff. So that's kind of all my stuff. Like I said, this is called Creately. You can see it up here. Dude, they got me. It was like $5 a month. I'm like, all right, man, this stuff's cool. And you can like take a like one of these little guys here, or whatever. I'll just do it over here. Oh, I gotta click this button. So if I did like here, I can just click like boom, boom, and then take like, it's kind of like lagging on me here, but you get the gist. I can kind of do whatever I want with this. I think I just broke it. But you can draw it out, and then you can pick where you want the lines to go, all that stuff. But that's pretty much it. I'm going to open the floor kind of up for questions. I think there's some questions here from Angela, Michael, and Victoria. Victoria just said thank you. Michael Gazda said, where's the best source to gain more credit card knowledge, like what cards and rewards, specific rewards, certain percentage back. So that, I would honestly just Google it and start reading some articles. You know, I don't want to take the lazy way out there, but typically I use travel rewards, and the reason why I do that is because you typically get more bang for your buck. So, for instance, if you spend like, I don't know, let's say $10,000, you know, maybe you'll get like, I don't know, like $100, whatever, right, worth of points. But with travel rewards, it's usually like 150 or 200. And the reason why they do that is because they don't want to give you cash back. They'd rather you use it on travel. But so my theory is like, don't use the travel for just to get more points and then spend it on a vacation that you weren't going to take anyways, because then you're just using that money and then you're going to go spend more money on the credit card that you weren't paying for. But like, let's say you already have a travel, which I do. I mean, I don't travel a lot, but I take 1, 2, 3 trips a year or whatever. For instance, I just use my credit card points on my business account, my other business account, and my personal account. And I'm going on, my friend's getting married, going out to Denver. The flights are free. I'm going to Nashville next weekend. The flights are free. The hotel was partially free, right? So I saved like, I don't know, 500, 1,000, 2,000. I think all of it came out to like close to like 1,500 to 2,000 bucks. So that's what I would say on the cards. But it depends on what bank you have. I have Bank of America, so I have a lot of money in Bank of America. So I get like, I think like a time and a half or 1.75 the amount of points. So I would just kind of look it up and see kind of what your bank offers. Maybe they'll give you more for being a card holder. But like I said, with the rewards, you really got to be careful. You do not want, you're making like a penny, right? You're making like 1 to 2% of whatever you spend. So think about $1. I saw this actually on Personal Finance Club today. Don't spend $1 to get 2 pennies, right? So you got to think about it like that. So what brokerage company do you suggest for someone who's 100% new to stocks and investing? Same kind of thing. Like I just went through Merrill Edge, I think, first, because I had Bank of America and I set it up. It's pretty user friendly and you can do it online. Depends on what you're investing in too. I mean, you can open up an account through like Vanguard is pretty reputable. Fidelity is pretty reputable. You know, there's a lot of brokerage companies. I'm trying to think of like if there's anyone we should really stay away from. Robinhood can be good because it's so user friendly, but it's also just not really like mature, I think, enough yet. And there's a lot of issues with the app itself. But you know, if you're buying and you're holding long term, I don't think it's that big of a deal. Like I told my girlfriend, because she's starting investing, to open up an account with Robinhood because it's awesome. Like, you know, it's kind of like, you know, like Snapchat or Instagram where it's got like all the different news and stuff. So you can kind of like scroll through it like you're scrolling through Instagram. So it's not a bad option. There's also Webull, W-E and then Bull, which is good as well. It's great, mobile friendly. Betterment. I've heard of it before. I'm trying to Google it right now, let's say, because I'm trying to remember what this is. I'll tell you I'm not using it, which doesn't mean it's necessarily wrong or right, but I mean, there's so many different things out there. Sorry, let me get this out of better. So it's like kind of like I don't know. I mean, it looks like something where you kind of like plan your financial plan all together, and that's not good. Here, let me make sure this thing's plugged in. I don't know if that just worked, but yeah. So this looks pretty cool. I mean, I don't know enough about to really tell you, but thank you guys so much for coming out. It looks like there's still like 14 of you guys hanging in there, or 13 or so. We got Angela, Dom, Jesus, John, Mr. Polanco, Marcus, Michael, Naomi, Raleigh maybe, and Victoria. I just want to thank you guys all personally. That's really all I have for tonight. I promised you guys an hour, but I knew I was going to talk a little too much, so I hope it's all right with you guys. Hope you guys got a lot out of this. Like I said, just be sure to share, man. Share the wealth. If you guys have like Instagram or anything like that, hit me up. You know, if I'm not already following you, like it's hard to kind of manage all that stuff. I know I message you guys and sometimes I realize I'm not even following some of you guys, but hit me up, man. I'm here for the friendship, here for the knowledge, here for the community. I want to start a community together. You guys are a part of that. And again, thank you guys so much, you know, for being here. So I'm gonna wrap it up. But thank you guys again. Just trying to figure out how to get out of here. All right, let's see. All right, guys, I figured it out, so I'm actually signing off this time. Thank you again, and please DM me your thoughts. You know, like tell me how it went. I know I got some feedback here, but just go ahead and message me. You know, on Instagram, say, hey, you know, you know, this is what I thought. This is what you know, constructive criticism or praise or whatever. Just let me know how I did, and you know, like I said, share the message, and I'm always looking to get better and help serve you guys however you need. So for one last time, I am signing off.